There's a list on the Wellings website that talks about your priorities. One of those is diversification over simplification. Tell us about the downsides of that diversification.
The downsides of diversification, well, I mean, one would be if you have, like if you would have just invested in that mobile home park in Louisville, you would have had an unbelievable return, an unbelievable great outcome. If you would have just invested in the $2 million self-storage place in St. Paul, Minnesota, you'd had a terrible outcome. Of course, they buffer each other. So, the great ones are buffered by the lesser ones. Another downside I mentioned, and I want to be real clear about that, is we have investors who don't really like the idea of filing taxes in multiple states. And I get that. It's a pain. I mean, it takes me 5 minutes a year to do that, but it's a pain for the CPA and it does cost extra money. So that diversification does come with a price.
Yeah, I think that's probably the main one for passive private real estate investors is if the fund's in multiple states, at least by the end of the fund, you're going to be
Right.
filing in those states.
Right.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.